Welcome to my tutorial on the accumulation distribution indicator. In this video, we'll go over the primary inputs of this indicator, how to effectively use it when trading, some of its limitations, and a few examples of how I've used it in my own day trading over the past month. The accumulation distribution indicator basically measures how strong a trend is using price and volume inputs. It is also known as AD, not to be confused with Los Angeles Laker Anthony Davis, who also goes by AD. Here's a mathematical calculation of the accumulation distribution values, courtesy of Investopedia. I'm not going to bother dissecting it because luckily we have computer software to calculate it for us, but the big takeaway here is that the relative close price and volume are the biggest inputs for this calculation. The higher a candlestick closes relative to the previous candlestick's range, the more AD will increase. The lower a candlestick closes relative to the previous candlestick's range, the more AD will decrease. You can think of volume as an additional multiplier here. The higher the volume on a particular candlestick, the more AD will increase or decrease depending on where the close price is relative to the previous candlestick. We'll go over examples of how the relative close price and volume affects AD and how it can assess the strength of trends in the next section. So to properly analyze the accumulation distribution indicator, we have to compare the AD line with our price chart. So here we have TradingView open, which is my preferred charting application, and I just pulled up the most recent 5-minute price chart on the S&P futures as of the date of this recording, which is August 13th. So to add AD to your chart, you click on Indicators, search for Accumulation Distribution, it should come right up. You just click on it, and that'll add AD to your chart. I'm going to show examples of how AD works using very recent data, which should hopefully prove that this indicator is still very applicable, and I don't need to go back far at all to get good examples. So the first application of AD is trend confirmation. So here on Friday, we can see that as price was increasing, AD was also increasing. So this basically just confirms the uptrend, and you can consider taking a long entry to follow the trend. So on Thursday, in the morning, we can see that as price was decreasing, AD was also decreasing, thus confirming this downtrend. So at any point here, we could have looked for a short entry. So taking these kinds of confirmation trades can be very profitable, especially on strong trend days, such as the one on Friday. If you had entered long here and stayed in the trade so long as AD continued to confirm the uptrend, you would have made considerable profit. So going back to this downtrend example, if you had entered short based on AD confirming the downtrend, you could stay in this trade until you saw AD divergence. And these are instances where the AD line seems to contradict the price chart. So as mentioned earlier, AD measures the strength of a trend, so a divergence would signal that the trend is getting weaker. So here's an example of divergence. And these are a little more difficult to spot, so let's zoom in a little here. So here we can see price continuing to make lower lows when AD seems to be making higher lows. So this is called bullish divergence and indicates that the downtrend is getting weaker and price may start rising soon, which we see does play out. The opposite of this is bearish divergence, which is when price is increasing but AD is decreasing. So here's an example of that. We can see that here price is making higher lows, but AD is making lower lows. This indicates that the uptrend is getting weaker and price may start dropping soon. So if you're in a long trade, you would consider exiting, and if you weren't in a trade yet, you would start looking for a short entry. And we can see here that upon this bearish divergence forming, price does indeed start to drop. So these divergence examples weren't the easiest to spot, but I have found that the more obvious the divergence, the more likely and larger the reversal will be. So you probably noticed that I was comparing pivot lows to spot divergences. This is because sometimes it's difficult to properly compare the AD line chart with the price candlestick chart. So using pivot highs and pivot lows tend to make spotting divergences a little bit easier. Here's a great example of how volume acts as a multiplier. On this candlestick, we can see that price actually decreases slightly as indicated by the red candlestick, but AD rocketed up. This is because this candle closed near the highs of the previous candle, so AD increased, but the massive volume on this candlestick made AD increase by a much larger extent. This massive jump in AD actually creates bullish divergence. We can see that price is making lower highs when AD is making higher highs. So this would be a signal that this downtrend is losing strength and that price is likely to reverse upwards in the near future. If we zoom out, we can see that this bullish divergence does indeed play out the very next day. One last thing to note is that it's important to wait for the price candle to close to lock in the AD value before making any decisions. Because the candle close price determines the AD reading, there can be instances where a high volume candle's price can seem to cause divergence in AD during the candle, but by the time the candle closes, a divergence may be gone. If you see AD swing around wildly, it's best to wait for that candle to close first before relying on it for a trade. So we have to be extra careful if the range we're analyzing has a large difference in volume, as it may skew the AD reading since volume is such a large input. So here we're looking at some price action that encompasses both pre-market trading as well as market hours trading. And we can see that it seems as though there's bearish divergence on AD because AD is making lower lows when price is making higher lows. This is a bit of a false signal because we can see that the first candlestick upon market open had a lot more volume than the previous candlesticks, and this ended up dropping AD quite a bit. And we can see that this bearish divergence was a false signal because price does end up pumping quite a bit after the market opened. So in general, it's just best practice not to use AD to analyze ranges that encompass both pre-market and market hours. So while AD divergences can signal potential reversals, it doesn't give you much insight into when these reversals will play out. So going back to this previous example of bearish divergence where AD was making lower lows and price was making higher lows, we can see that price actually went up a little bit before the bearish divergence played out. Sometimes it could also be a false signal and there may not be any reversal. There's also just inherently more risk going against the trend to try to catch a reversal, so it's important not to solely rely on your AD for trades. It's best to use other indicators for confluence and also to make sure your entries are near potential support levels to increase the chance of a profitable trade. In this first example, we can see clear AD bullish divergence. AD was making higher lows when price was making lower lows. I saw stochastic RSI curling upwards and entered long at the lower VWAP band, 9 EMA, and the value area low, all major support levels. Unfortunately, I get stopped out here as this shows one of the limitations of AD, where sometimes it takes a while for the divergence to play out, and there's a risk of getting stopped out before it happens. This next example takes place shortly after the first one. After dropping a bit, price pushes back above these same key support levels, and the AD bullish divergence is even stronger now. Stochastic RSI is also curling upwards again, so I take the same long entry around the same support levels. This time, the bullish divergence does play out, and price shoots upwards to hit my profit target. In this last example, I noticed AD bearish divergence and started to look for a short entry. AD was making lower lows when price was making higher lows. Stochastic RSI was also on its way down, so I entered short around the 9 EMA and the volume point of control. This time, the bearish divergence plays out immediately as price begins to plummet shortly after I enter and hits my profit target. Accumulation distribution is a powerful indicator that uses relative close prices and volume to assess the strength of trends. As you probably noticed, I personally prefer to take trend reversal trades off of AD divergences when other indicators are in confluence. When entering near key levels, I found the strategy to be highly profitable and wanted to share it with all of y'all. To see more of the strategy in action, check out my other videos where I've been uploading fully transparent day trading recaps for all my wins and losses on my Apex Trader funded account. I'm by no means an expert, but it's been fun documenting my growth as a day trader and also the growth of my Apex account balance. Thanks for watching. If you found it helpful at all, would appreciate a thumbs up and feel free to post any questions in the comment section. Please also consider subscribing to follow along on my day trading journey.